Family investment companies are sometimes described as technical planning tools, but in practice, they reflect a more ordinary concern: how to hold wealth in a way that allows for growth, some control, and makes the transfer of wealth easier to manage. In this episode, we'll discuss whether a FIC is right for you, the main differences between a FIC and a trust, and whether they're worth it or overkill for your situation. To help us unpack these issues, we're joined by Gareth Jenkins from James Hambro Partners. Gareth is a partner with the firm and an experienced financial planner who works closely with families on long-term financial planning. So Gareth, thanks so much for joining us. What is a FIC and who are they most relevant for?
So a FIC is a term that gets used a lot these days. So FIC, just family investment company. It is in reality just a fancy term for a company structure that is typically then used for estate planning or wealth management needs. So a FIC can be useful for clients for a number of reasons. Historically, they have just been used as pure play investment vehicles. So that's for clients who want to hold assets inside a company structure rather than holding them directly themselves. And they might do that for a number of reasons. There are a number of tax benefits to FICs. So for example, currently dividends received inside a company structure aren't taxed. So there are many reasons why clients like using FICs just as a way of holding assets. More recently, they've been more commonly used as an estate planning vehicle and as an alternative to trusts. So they are used a lot by wealthier families who want to maybe remove some assets from their estate. So they've done some wealth management planning. They've realized there are some assets made in their estate that are what are called excess assets. They're never going to spend them. They want to reduce the IHT liability. They want to get the assets outside of their estate, but they maybe don't want the beneficiary to be able to control or have any access to that asset. So in the same way as a trust, they can be used as an estate planning vehicle to remove assets from an estate, but still retain some form of control over that asset if you're worried about how the beneficiary might, what decisions they might make on those assets.
Understood.
So they're a commonly used estate planning vehicle.
Thank you. And drilling into that a bit further, what factors need to be considered prior to setting up a FIC?
So when you get to the point of setting up a FIC, there's typically been quite a lot of advice given. So for example, you would probably have spoken to your wealth manager. They would probably have built quite a detailed model around how your finances might change over time. So you're really then just making sure that if you're going to use a FIC for estate planning purposes, the assets you're planning to settle into the FIC aren't going to be needed for a client's lifetime expenditure needs. So in super simple terms, we're looking to make sure a client remains financially independent. What's that mean? It means living where you want to be able to live and spending what you want to be able to spend. And if you can identify assets that aren't going to be needed to meet those objectives, you would settle them into the FIC. So financial modeling from a wealth manager to show you that there are excess assets that aren't needed. You would then probably compare other options available. So discussing other estate planning vehicles and tactics that can be employed when you get to the point that a FIC is identified as a beneficial solution. At some point, a solicitor will have been engaged to provide advice on that structure. They can be quite technical. So depending on the family circumstances, who the beneficiaries are, how you fund the company, how many shares you've set up in the company, who the owners of those shares are, how many different share classes there are, what different rights each of those different share classes have, because you have different classes with different rights. Other questions like, do you hold it onshore or do you hold it offshore, are all then technical points that you would need a legal professional to go through with you. So typically between a wealth manager and a solicitor, you would receive written advice on how that structure is going to benefit your family. But that legal advice and setting up those documentation and getting the company registered is then covered by the solicitor. At the end of the day, you then do just end up with a company structure. There's nothing special about it. It's just been specifically designed for each individual family's specific needs.
People often describe FICs as a way of freezing wealth. What's that idea really mean in practice, and what remains flexible?
Yeah, so good question. So in a way, how it freezes wealth. If you've gone down an estate planning journey and you've identified that there are assets in your estate you're never going to spend, then if you don't do anything about that, then one, those assets remain in your estate, and on the second death of a couple, they would be taxed to IHT, which is a 40% tax charge currently on the value of assets above a nil rate band. So if you don't do anything, and if we assume those assets are being actively managed and they're in some form of asset that's growing, then actually that IHT issue for the family is getting bigger. So whatever the value of your estate is that you need to keep, and then you've got these excess assets, and hopefully if both of them are growing, then the issue is your IHT liability is potentially getting worse over time. So the benefit of using a structure like a FIC, and it could also be a trust, or it could be an outright gift, is when you've identified those excess assets that you don't need, you remove them from your estate, and then those assets, the continued growth on them, the growth is immediately outside your estate. So if we assume the gift that you make is what's called a potentially exempt transfer, so it's a gift that after 7 years would fall outside of your estate, you've got 7 years before that gift is removed from your estate, but the growth on the asset, whether it's in a FIC or a trust or an outright gift, is immediately outside of your estate. So the remaining assets that you keep in your own name and whatever structures you use for that are the only assets that remain in your estate for IHT calculation purposes. So a family investment company is a good way of freezing the value of your personal wealth, i.e. keeping what you need, and hopefully you're just spending the growth so that the IHT liability doesn't get worse. There are more complex forms of share classes that can be used inside FICs, whereby you can hold the company structure in your own name, and the growth on that asset above a certain value falls into somebody else's name. So if you've got a notional value that you want your estate to be worth, a FIC can be a very useful structure by saying, actually, I'm just going to freeze my wealth at this level. And what's sometimes known as a flowering share would mean that the growth can fall into somebody else's name, whether that's a child or some other beneficiary. So they can be a very useful way of protecting the value of your estate to stop the IHT liability becoming worse.
How do FICs differ to trusts when looking at the balance between control, growth, and future decision making?
Yeah, so in some ways they're very similar. They are a vehicle that you can use to hold assets that removes the asset from your estate after typically after a period of 7 years, but whereby you retain control over the assets. So if you're worried about, if you've gone through that estate planning journey, you've identified assets you don't need, you want to get rid of them from your estate, but you want them to go to somebody and you're worried about what they're going to do with those assets. It's a very useful way of starting that clock, but retaining control over the asset. The main differences between them are, one, related to taxation, and two, then probably related to ongoing planning with the structure. So the main differential in money going in is that a FIC isn't money that goes into a company structure or a family investment company isn't subject to what's called a chargeable lifetime transfer. So if you want to make a gift into a trust above a certain value, then what's called a chargeable lifetime transfer is applied, and you have a 20% tax charge on the money that goes in, and that's typically above your nil rate band of 325,000 at the moment. As an example, if you were putting £10 million into a trust and you'd already used your nil rate band, you've got a 20% tax charge. So for somebody who wants to put £10 million into a trust structure, but they have to pay £2 million to get the money in there, that can feel like quite a draconian tax charge. So the benefit of the family investment company is there is no upfront tax charge to get the money in there. You can put the money in there. There is no, in that case, 20% charge. The other benefit of the FIC is it doesn't have what's called a periodic charge. So the other charge with trusts gets applied to what's called a periodic charge, and it's a charge every 10 years at currently a level of 6% above your nil rate band. So for larger trusts, there can be a very high periodic charge every 10 years. So you think, again, 6% of the value of the trust above a certain value every 10 years, 0.6% per year, it's quite a high level of taxation. Again, you don't have that issue with a family investment company. So family investment companies can be set up, and in a way they are, from an IHT perspective, initially far more tax efficient than a trust, but you get similar benefits in terms of control of the assets and who it goes to. I suppose to balance that argument, the benefit of a trust is, with regards to the beneficiaries, you don't have to have a single named beneficiary. So when you set up a company structure, the shares have to be held by an individual, or you put the shares in an individual's name. You then need a plan for that at some point in the future. Whereas with a trust, you can set a category of beneficiary, and you don't need to worry about changes to that class of beneficiary. It's probably a better long-term structure in terms of ongoing management of beneficiaries. So there are a number of differences between the two structures. Some lawyers might prefer the underlying legislation or protection the trust gives over a family investment company, but they are very similar in terms of the protection they provide. Family investment companies are probably more tax efficient for most clients when you're looking at those bigger numbers.
Sure. So you may have touched upon this already in that answer, but why do you think these structures have become more common in recent years?
I think it is that point on taxation. So for people who want to settle bigger sums into a trust, if they can't claim some form of relief on the money that goes in, so that they can avoid this, what's called chargeable lifetime transfer, for bigger sums being settled, a company structure gives you most of the benefits of a trust, but without the upfront tax charge and without the 10-year, what's called the periodic charge every 10 years. So the company structure also has some other benefits as a taxation structure. So you can offset certain costs. You don't get the dividend taxation. There are other taxation benefits to holding a FIC, but in simple terms, yes, the bigger sums, there is no 20% tax charge to go into them. And for that reason, we have seen them increasingly used over the medium term now. They've been around for quite a while.
Sure. And I mean, obviously the tax calculation grabs the headlines, but what are the long-term considerations need to be made by the family?
Yeah, so I suppose with family investment company, long-term, you do need a plan with that structure. So, and probably more so than you would do with a trust. So with a company structure, you are putting shares in a beneficiary's name, albeit the beneficiary typically doesn't have the voting rights to be able to access the underlying asset. But on the basis that a company structure is more complicated and costly to hold assets than just holding assets outright in directly in somebody else's name, I have seen cases where a client's initially been advised and then not received ongoing advice. And you meet clients or families where they've got quite adult children, and there's quite a complicated company structure set up that sort of inhibits their ability to access the funds. But they need the funds because they're very settled in life, and they've made good financial decisions. They've been educated, and you then end up unwinding the structure maybe later than you should have done. So you do need to think when you go into it, what are the reasons we're putting this structure in place? And that is typically because you want to give the money to a beneficiary and you don't think they're of the right age or position in life to do that. That might be because they're very young. It might be because they're not settled in life yet. They might not be married. Parents might be worried about things like divorce, but also just younger people making bad decisions when they've got a lot more assets than they need. That might tie into, families wanting to make sure that, children sort of maintain the right drive, motivation in life to work hard and achieve their own objectives rather than just falling back on an asset that's in their names. So you do then need to think, right, at what stage would we potentially unwind this structure? Or do we do it when a child reaches a certain age, or when they're settled, or when they've had children? Or there needs to be a plan. So going into the structure, that does need to be part of the longer term planning, which a wealth manager or a solicitor can help you with.
Sure. And just to pull things together, when you step back from the technical detail, how do FICs shape the way families should think about time, about ownership and responsibility across the generations?
Yeah, it's a really good question, because a FIC is a structure that can benefit families immediately, and that you can start your IHT planning journey. You can get money outside of your estate, start that 7-year clock or shorter as it may be, to reduce your IHT liability. But it doesn't solve the problem of needing to educate the next generation on wealth. So it can be a useful structure to engage younger family members to say, right, there's this money put away from you, you can't access it, but it's being managed for these reasons. And often for beneficiaries, that might be for education purposes, or it might be for future property purchases, or it might be for, couple of next generation school fees, whatever that might be. But a family still needs a medium to long-term plan on how you educate the next generation, because at some point when kind of mother and father have eventually passed away, you can control assets for as long as you like, but at some point the children are going to benefit from that money, and they need to know how to engage with the right professionals and how to make strong financial decisions. So whilst FIC is useful short term, whilst maybe people aren't of the right age to receive money, families still need medium to long term plans on how to best educate the next generation. And a FIC, like a trust, or like even a GISA for a sub 18-year-old child, is a way of engaging children with wealth management and legal discussions without them being able to physically access the money and run off down the Porsche garage.
Yeah, yes, indeed. Gareth, thank you so much for your time today.
Pleasure. Really nice to join you. Thank you.